Hey everyone, and welcome to Talk ETFs, our weekly video series where we sit down with experts and thought leaders in the ETF industry and beyond. My name's Sumit Roy and I'm Senior Analyst here at ETF.com, and I got a great show lined up for us today. My guest is Bruce Lavine. He's the CEO of Night Shares, an ETF issuer focused on capturing the night effect within stock markets. Bruce, welcome to the show.
Thanks, Sumit.
Bruce, it'd be awesome if you could start by telling us what the night effect is.
It's this really interesting phenomenon that we discovered and then discovered other people had discovered, where the overnight markets tend to outperform the daytime markets on a risk-adjusted basis. You tend to get more of your return from the overnight markets and more of your volatility from the daytime markets. And so, the Night Shares company is created ETFs to separate these two very different return streams of night and day for the first time. And so we're quite excited about it.
So Bruce, what's the performance difference between an overnight strategy and a traditional buy and hold strategy?
So what we saw in our research, and we went back 20 years, the research on this has gone back further than that. We found many, many white papers. We found about 75% of the return from large cap was coming at night. And you were getting that with about 60% of the volatility. And so that had a higher Sharpe ratio than the buy and hold index. And in particular, when you think Sharpe ratios, which is kind of your return per unit risk, the real problem child was the day session. The day session had a poor reward. Returns were low, volatility was high. So that was large cap. Now, small cap was fascinating. We found that over 100% of the return of the Russell 2 over 20 years came at night, and that the day session was negative. And the day session also had a lot more volatility than the night session.
Interesting. And how do you go about getting exposure to the night effect? Do you simply buy stocks at the end of the day and then sell them the next morning?
The challenge with the night effect, capturing it is the whole execution process. And we try to do this in the most efficient way possible. So we hold in the funds, there's actually three funds. The first two are pure overnight. And so they hold cash and treasuries. Think of it as a collateral pool. And at the end of the day, they buy futures on the S&P 500 or the Russell 2000, very close to 4 o'clock. And then the next morning they sell them out. And so you have that overnight exposure, but you don't have the daytime exposure. The third fund we have is interesting. It's got 150% exposure to the night and 100 during the day. So that's one where, even though the day is sort of poorly rewarded over time, it certainly has its moments. And so if you don't want to sit out the day, that's an interesting product. And that one historically had done about 300 basis points over the index, before transaction costs and fees.
Got it. And then, Bruce, I was looking at the chart you have up on your website, and you can clearly see the appeal of the small cap night effect ETF. It has better performance, lower volatility. It's a win-win. But then you look at the S&P 500 night effect ETF, and you're giving up a little bit of performance. It does have lower volatility, though. So who is this product for?
So so we have these two ETFs. We have NSPY, which is essentially just the overnight, and that's the one that gets you 75% of the return and 60% of vol. And then NSPL, which is the one that if you want a return product that can actually beat the S&P over time, that's the one where you lean in with 150% to the night and 100 during the day. So if you looked at like a risk return plot, you'd see that those two products sort of sandwich the S&P. One's got substantially lower volatility, gets 75% of the return. The other one has a little bit more volatility than buy and hold. But what's interesting is because you're leveraging only this night session, which is a much lower volatility session historically than the daytime session, your total vol on the product's not that high. It's about maybe a 23 versus 20 for the S&P, something like that.
Now, Bruce, you have ETFs tied to US small caps and US large caps. Are there any other segments of the global markets where you see the night effect being prominent?
Well, one of the fascinating things in the research is the night effect is a global phenomenon, which is why we think it's quite structural in nature. So if you are a Japanese investor in Tokyo, buying the Nikkei close, selling it the next morning, you see a similar thing. If you're a German investor and you're buying the DAX at the close and selling it the next morning, you see a similar night effect to what we're talking about. So it seems to persist in the local markets. And we attribute that to this sort of structural de-risking, let's call it, that goes on at the institutional level overnight. Institutions don't want to hold more risk than they need to. So they sort of flatten their books at the end of the day. And then the other thing is there's an investor behavior component that really only exists during the day. So at night, markets are kind of, there's not that many people trading. If the general tendency of markets is up, that's what happens. And it's when all the players get involved, all the algorithms, all the day traders, and that's what seems to detract from overall performance.
Fantastic. Well, thanks so much, Bruce. A ton of great information. Thanks for taking the time and sharing your insights on the night effect with us.